Hello everyone, hope you're all well and thank you for joining us for this special GTR webinar, Trade Finance Funds 2021. My name's Jeff Andor, I'm Director of Content and Production at GTR and I'll be your host for the next 100 minutes, during which we'll do our best to offer a forensic examination of the world of trade finance funds. As we know, the trend towards greater use of non-bank finance has been ongoing for some time, creating a thriving sector that brings the world of traditional trade finance together with institutional investment and asset managers. From different types of funds to investor perspective to the role of technology, there are many aspects to this evolving ecosystem. We'll be reflecting on some of the most notable developments around this with a fantastic lineup of speakers keen to share their views. Please do use the Q&A function on your webinar screen to submit questions. A special summary Q&A session at the end, so we'll go through any questions then. Our first segment looks at how funds are defined in the market, some of the differing models, as well as asking whether they should now be considered part of the trade finance mainstream. And to lead this, I'm delighted to welcome Aidan Applegarth, who is Managing Director of BankingWise. Aidan has been active in trade and commodity finance for over 40 years, working for a number of FIs and more recently as a consultant advising various funds. Welcome, Aidan.
Thanks, Jeff. Welcome, everybody. I guess one of the first things to address here is really what do we understand by trade finance funds? It's a term that's out there in the market. It seems to be different things to different people. There are funds doing pure working capital. There are funds doing impact investing. There are funds just doing receivables. So perhaps if I could open it to the floor, and Dave, maybe if I could get your take initially on how would you define a trade finance fund?
Sure, thank you. Hi, Dave Skrzynski, CEO of Raystone Capital. We see a fund as entity which raises capital for which to then purchase assets. And those assets, as you stated, are very specific. It's either going to purchase loans, it's going to purchase trade receivables, and even more specifically, it's going to have a certain risk box and operate within that risk box. Trade finance funds are typically not the originator of the original deal, and they may not even be the servicer doing all the belts and suspenders, payments, collections, and reconciliations. They're a vehicle that is intended to raise capital from limited partners and then deploy that capital.
Dave, is that something that you see also as reflective of where Levantor is?
Yeah, absolutely. I mean, I think Dave set it out correctly. At Levantor, we are the originators. So we work with large institutional investors, including very large banks, to originate assets for them. So trade finance funds are certainly investors that are quite keen in sourcing assets through our platform. We tend to see them bucketing generally by those that are looking at more, traditional trade instruments, cargo specific types of investors, LCs, that sort of thing, looking at generally kind of a higher yielding, say 5+% yield. And so that's one bucket. The other bucket tends to be those that are looking at the payables, the receivables, the supply chain finance types of assets with a yield target of less than 5%.
Thank you. And I guess, is it fair to say that for trade finance funds, actually there's different stages of the process? So it's more of you've got to take the money in on the one side, you've got to deploy it on the other. How does that fit in for NN Investments, Ulla?
Yeah, indeed. So at NN Investment, we do have maybe a slightly different approach because we manage investments, portfolios, mandates for institutional investors, pension funds, insurance companies. So indeed, it's a question of how to deploy capital efficiently and also how to create diversified granular portfolios that offer additional benefits like low correlation to more, let's say, traditional fixed income asset classes. So indeed, it's worth focusing where the money comes from, what those kind of investors are looking for, not only in terms of yield, but also in terms of capital efficiency, talking about solvency too, and then deploy it in a very efficient way.
So that when you set up a fund, then do you begin with that end in mind, or are you beginning by looking at what the needs are in the market to fulfill that? David, from your perspective, how was that the thinking process in Levantor?
Yeah, I mean, I think it's with all of our investors, we have to understand, at a very detailed level what their target market is. So, whereas traditionally we started out with banks, it was very much focused on relationships. Where is their target set of clients? Those are the ones that they want to come in and support with the capital that they're putting to use through our platform. With the trade finance funds, it's generally not relationship driven. They do have obviously a very well-defined risk return profile that as far as the ones that we have spoken with and worked with, yield is obviously a very important part of that. Other factors such as public listing, private company, geography, currency, tenor. Each fund tends to, in our experience, have that checklist that we work with them, and then we will just basically match the assets that we show them to that target profile that they've established.
Thank you. And I guess that has impact then on the operating model that is chosen. Are you within your areas seeing an operating model, Ulla, for example, that is specific to NN Investments, or would you expect your model to be actually reflective of what other funds are doing?
Well, I think when we started, it might have been specific, but as we proceed and as we look at the market, we see more and more participants coming up with funds and strategies similar to ours. So in the end, what we don't want to do is kind of taking over the relationship part or replacing an originator or replacing a bank. That's not our intention. We purely look at it as a financial investor. We are looking for solid, stable assets and investments we want to invest in, and that on an ongoing basis. So it's for us, we of course do cooperate and discuss with originators. We do partner up with sourcing partners, of course, because we need to have this. We are a asset management firm. We are not an originator. We are not a servicer. So I think that's quite clear to distinct or have the differentiation between the two different roles you have here.
Thank you. And I guess what this is setting out is an ecosystem. And I think, Dave, in terms of the setup that you have, the ecosystem, we've already had banks mentioned, but where do you see the role of banks at the moment in that system?
Sure. So we're a little unique at Raystone because we are a prolific originator, we are a servicer, and then we distribute assets to banks, hedge funds, family offices, and more often trade finance funds. And we even created a trade finance fund to fill some gaps that were in the market where we couldn't find anyone to buy the assets. So banks are absolutely, for a while it looked like banks were going to exit the trade finance space because of Basel III, but they've certainly been partnering more with fintechs now and getting back into the space. But banks will always stay within their box, which is generally investment grade clients that they have a relationship with, they can cross-sell. So non-banks are going to continue to grow in this space tremendously and I think have a great success.
Thank you. And David, I guess also your experience is engaging the banks as well at the moment.
Yeah, absolutely. For us, there's a very natural balance in the funding that we source between banks and non-bank investors, and it's exactly what Ulla and Dave just touched on there. These are short-term recurring trade flows that very much embed themselves in the commercial relationship between the buyer and the supplier. So for us, it's very, very important that continuity of funding. It's all uncommitted. Any funder can pull out. We never gate. We never, have any restrictions on withdrawals. So it's very key that at least a core of the funding comes from banks that are relationship driven. We saw this last year with COVID, where the banks didn't pull out. The funders that we had in, they didn't pull out, they didn't cut limits, even in the spring of last year when, there was a lot of pressure and a lot of angst about, default rates going up and delinquencies. We've had none, fortunately, but that's really the role of the banks. We need that relationship anchor. But at the same time, Dave hit it right on the head there, was when we're out originating, we need funders that are not relationship driven, who have that ability to take a view on risk and say, yes, I'll put investment down on this flow, allow us to bring it in, get it funded, bring the banks in behind, and then continue to build out that basically flow by flow syndicate. And it's generally a mix of banks and non-banks.
Thank you. And I guess, Ulla, it's similar for you? You're seeing the banks as well?
Yes, of course. So for us, we talk to about 20 to 30 partners when it comes to sourcing assets. It's banks, it could be fintechs. So it's a variety of partners we're talking to. But banks, of course, still are a very important counterparty in that market.
That's interesting to hear. I guess, different perspectives. I've seen some funds who struggle to get recognized by the banks, largely because it seems in some cases the banks don't understand sufficiently the governance around the fund. So particularly they think about the provenance of the funds that are put into deals and so on. And that, given what was happening last year with the banks retrenching, was seen as perhaps being a constraint to the market. But what I'm hearing at the moment from all of you really is, no, it shouldn't be a constraint. There is a role for them to play. And at the moment, they are active, notwithstanding that difficulty in the market. Is that fair to say?
It's fair to say. I mean, during COVID, certainly banks lent, the revolvers were drawn by corporates, and that put a cash crunch on banks. But that only lasted a few weeks, and pricing moved up for a few weeks and then normalized. But where again, Basel III came into play is there were a lot of retailers that were investment grade that during COVID slipped to double B minus. And the banks exited the trade finance programs. And that was impactful. And in the institutional market, non-banks stepped in to fill that gap. So, what people look for in a fund or anyone is consistency.
Thank you. So I guess it brings us on to the subject of challenges, really, that and to grow the market from where we are today. Where do you see, Ulla, from your side, where do you see the key challenges?
Well, for us, I think, again, coming back to our investor base, it's really explaining the asset class to our investors, because for some of them, it's still relatively new or even unknown. And coming back to the basics, what is trade finance about? And where do you need to focus on? And what we've seen and what we still discuss a lot with our investors is really about how you access the market. What kind of analysis do you have to do and perform? How thorough are you? What are kind of the tricks? So it's about know your client. It's about what kind of asset am I actually financing? Where am I financing? Are the cash flows secured? So these are all the things you really need to focus on and put a lot of work into that to make it really a stable asset class over time and not just for, let's say, a one-off event.
Thank you. And I guess, David, that's something which, given Levantor's milestone earlier this year, you've accomplished reasonably well. Where do you see the ongoing challenges, though?
I think it's definitely still a learning curve for a lot of non-banks coming in, figuring out exactly which bit of the market do they want to play in, what the appropriate yield expectations are for the level of risk that they're taking. Getting comfortable with the instruments, looking at the underlying cash conversion cycle, all the things that trade banks have been doing and getting comfortable with for centuries. The non-banks are coming in and figuring that out now. So we tend to see a lot of interest up front. It does take probably more time on average for a lot of the non-banks that we speak with to get up the curve. But they once they do, I think they find that this is a very attractive asset class because it is recurring. It's annuity revenue, and it's there, and it's uncommitted. It truly is. It does offer that short-term, high-quality exposure.
Thank you. And Dave, anything to add to that?
So trade credit is larger than the entire consumer lending market. So it's a massive asset class, but it's also a very diverse asset class, from credits from 1% per annum to 60% per annum. One thing I've found is funds need to understand the servicing, because credit risk is the smallest risk in this equation. It's fraud and it's servicing risk. The second is, we will finance a $100 million transaction on 18 pages of paper. And I think at first people are used to a 700-page offering memorandum and loan agreements and covenants, and they don't understand how you can possibly do this on a few pages of paper. But I think the thing for funds to understand is that trade finance, per Google, was started 4,000 years ago by the Mesopotamians. So this is not a new asset class. It's one the banks loved and hogged until such time as Basel III came along and the banks, found it a little more difficult to participate as much as they can. But all the things that we heard before stand true. There's plenty of reports on the internet on the recovery rates of trade finance being higher, time to recovery faster, loss given default lower. And that's, my 20 years has absolutely proven out to be true.
Thank you. I guess what I'm hearing too is that there's room in the market. If the market is going to grow, you would welcome other players in the market, more club deals perhaps, to get the liquidity out there for those bigger ticket activities that maybe single funds aren't willing to take today. Is that something you see happening, Ulla?
Well, we are more coming from a asset manager, fund manager perspective. So for us, it's actually important to create a stable platform where we have for example, where we have an open-ended fund that kind of is intended really to be an evergreen, right? So, and we will see investors coming in, we will see investors going out, but the overall target is to keep this vehicle and this fund running. But certainly I can imagine that there also club deals will be down the road, especially if larger financial investors are entering that market. That's certainly possible.
Yeah. So I guess the issue of replenishment is a challenge you all face in terms of managing the funds, but a key part of that process is partnering up with the investment managers, those that can actually deploy the funds in deals that miss the risk profile. David, is that something Levantor is practicing?
Yeah, I mean, absolutely. We tend to focus on big ticket flows between large corporate suppliers and their large corporate buyers, typically retailers, distributors, telecom operators, just for example. So each of these individual flows is very large ticket, and it lends itself very well to club deals. There's very few of our flows where one bank or one fund or whoever would take the entire credit limit, and so it's really been a very natural arrangement to have anywhere from typically 3 to 6 funders funding each of those flows, and we just rotate them through. We don't see a lot of benefit to things like bidding platforms, trying to screw down the investors to the last basis point, because for us it's all about continuity. We need to have that capital available week in, week out, and we want to encourage the funders to continue to fund even though it's uncommitted. So it's a very natural clubbing process through our platform.
Thank you. So I guess in the last few minutes that we have, if I throw out to you, the key question here is, so are trade finance funds now mainstream? Or is it just perhaps that they're a little bit more up the alternative credit curve? Dave, what's your take on that?
Yeah, I don't think they're mainstream yet. There were certainly some very large funds that had some recent setbacks because they relied overly heavy on a scarce commodity of trade credit insurance. I think funds are going to continue to be, the future for this asset class, distributing the risk, into small bite sizes. Mainstream, I don't see it yet.
Okay, thank you. Ulla?
Well, I would agree with Dave. Mainstream, not yet, but I do think that trade finance funds are here to stay, and we will see more funds and more inflows into this asset class. And I would also like to mention, talking about mainstream, I think it's a nice asset class to really also incorporate sustainability aspects when you are investing. You can really create sustainable portfolios within trade finance if you do your research and analysis properly. And I think this will also, help to make this asset class even more popular.
I would agree with you there. I think that we're seeing the ESG promotion of funds much more than we had in the past. David, is that ESG something that drives what you're doing?
Yeah, absolutely. It's, the last 6 months that has come right to the top of the agenda with most of the funders in our panel. And I think there is a lot of opportunity, just like we tend to be more on the sales side as opposed to the procurement supply chain side, where there's also been a lot of focus on driving supplier behavior and incentivizing that with attractive terms on a supply chain program. There's just as much interest that we've seen from funders in identifying sales flows, big multinational, to their corporate customers where there is an ESG angle. And I think ESG, search for yield, search for large recurring flows of available assets. These are all things that I think ultimately will hopefully continue to drive the alternative investors, the non-bank investors, toward making this a much more mainstream asset class and mainstream funds.
Thank you. And I take it from that, I was going to ask you for your take on the mainstream, but you agree too, it's not there yet.
Not quite, no.
Yeah, thank you. Well, I guess in the final minute, is there anything that either of you want to add to the dialogue? Dave, any final comment?
No, I think everything that's been said is spot on. So looking forward to working with future folks. And, this, I guess for our passion is this helps us finance small and medium enterprises, because the banks don't want to do that, but funds with more flexible structures or complicated securitization structures allow us to do that. So, big thanks to all the funds, and thank you for our participation. Thanks,
Dave. Ulla, any final comment?
Well, I think it's an absolutely interesting field to be in, and also to see how this asset class will evolve over time. And I think now, especially looking at other fixed income or markets, I think it's a very, very interesting field.
Great, thank you. And David, final comment from you.
No, I think this is a very well-timed forum. There's huge opportunity here. Dave said it with the size of the flows there are globally, and so we would very much encourage non-bank investors, fund managers, who are interested in this, to help them along. So really appreciate the opportunity.
Great. Well, it remains for me then to thank you all, Ulla, David, and Dave. Thank you very much, and I'll hand back now to Jeff.
Many thanks to Aidan and to his group. We've had a lot of questions coming in, so I may revisit the group towards the end for the Q&A section. We've got some fantastic participation from our attendees, so thank you all very much for that. For this next session, we'll be looking at what attracts investors to trade finance as an asset class. And to guide us through this, I'm delighted to introduce my colleague, Shannon Manders. Shannon is, as you should all know, editorial director of GTR. And of course, you will know that GTR is the world's leading trade finance publication. So Shannon, the floor is yours.
Excellent. Thanks, Jeff. And hi, everyone. Thanks for joining us in this next session, during which, as Jeff has pointed out, we're going to be taking a look at the situation from the perspective of the investors. And we're also going to be taking a look at the role of ESG in the investment landscape. And I see there have been quite a few questions coming in about ESG, so hopefully we'll be able to get to those. Joining me in this discussion are three fantastic speakers, and I'd like to ask them to join me on this virtual stage while I introduce them very briefly. So Martin Offerman is a senior portfolio manager at Allianz. Dale Galvin is founder and CEO of Deliberate Capital. And Dawi Awasher is head of ESG and sustainable finance at Channel Capital Advisors. Welcome to you all. Thanks for being here. So, Martin, we've only got 25 minutes. Let's get stuck straight in. Now, given some of the negative attention that was alluded to in the previous chat that the trade finance industry has received of late and does receive from time to time, the big question for me is trade finance still an attractive asset class for investors? I feel like we've been having this conversation for some time now. But in your opinion, do you think that recent incidences of fraud, etc., have changed investors' perception of trade finance?
So very, very spot on question. Thanks, Shannon. In short, I think there's nothing wrong with the asset class, but there is a few things wrong with approaching the asset class. You alluded to some of the fraud cases. I think there were a couple of them last year and this year out of mid-sized commodity traders from Singapore and elsewhere. From what we hear, the institutional investors have not really been affected. This was mostly the banks. So on that side, I think the perception has not really altered. Much different to the fund that recently closed, the 10 billion out of Switzerland from the Swiss asset managers. That obviously affected investors and also investor sentiment. Needless to say, people were affected by those flows. Now, if you scratch just at the surface, you would say, okay, this could be considered bad for perception. Now, if you dig a little bit deeper, it actually shows that there's nothing wrong with the asset class. For instance, the investment grade funds, the ones which weren't using insurance, had absolutely no problem. And they were just shot, but their money good. The term future receivables, which we've been reading up and down Bloomberg over recent weeks, that has nothing to do with trade finance whatsoever. I mean, hot air can be produced in any asset class. Yeah, it's not something to trade finance. Yeah, and concentration risk. Yeah, managing concentration risk is nothing special to trade finance. Yeah, it is something that you need to manage as an asset manager, as Ulla pointed out in the previous section. In any asset class we manage as asset managers. So, and then, managing sourcing partners, who would set up a bond mandate where you would buy bonds only from one bank's syndication desk? Nobody would do that. So when you ask what is the perception of the asset class, I think there's nothing that changed the perspective of the asset class, but a lot that changed how we approach it as investors.
Yeah, thanks, Martin. That's a really good overview. So bearing that in mind and maybe flipping the question around a little bit, like what is it that attracts investors to trade finance as an asset class? And also how strong is investor understanding of the risk profile of trade finance and what the major benefits of the sector are?
Well, so the major benefits are, I think, sixfold. I think there's a compelling relative value in terms of risk return. Main reason being that there is a high operational barriers to entry. So there is a structural risk premium available. I think secondly, what we hear more and more is a fear of inflation and rising yields. So just short-dated assets, I think, are coming. I think, stable asset, low correlation. Ulla mentioned that previously. I think that's a theme that we hear a lot of times from investors. I think also the strong fiscal and monetary stimulus that is currently in markets. Nobody knows how long it's going to be there, But for our asset class, it's definitely supportive in the short term. So we're riding that wave, that secure wave in a way. And people appreciate that from a risk point of view. Fifth point is it's self-liquidating as receivables paid out of operating cash flow. People appreciate that this is a risk mitigating factor. And lastly, for insurers, I mean, the Solvency II treatment is quite favorable. These are sort of the reasons why investors speak to us and are approaching the asset class and doing the due diligence. Are they all appreciating the full comprehensive of the risk? It's hard to say. Huh? I mean, we're trying to be very transparent with the risks as they exist. Yeah, credit, fraud, dilution, delay, operational complexities, and so on. I mean, there are manifold, and it is a very technical asset class and a very broad asset class. But in the end, I mean, the low-hanging fruit in capital markets overall, they've all been crowded out and risk premia have been diluted, yeah, and minimized. And I think here we have still an asset class where there is sufficient risk premium to do the effort.
Thanks, Martin. Very interesting. Dawi, bringing you into the conversation now. So as we look at the role that this all plays in today's world, as we emerge into a hopefully post-COVID scenario, how can institutional investors and asset and fund managers, etc., help to bridge this now widening trade finance gap that we're constantly talking about? And what do they need in order to do so?
Thanks, Shannon. Good afternoon, everyone. 2021 and the post-COVID recovery present a unique set of challenges. The IMF quoted that the global economy shrank by around 3.5%, worse than the 2008 global financial crisis. In trade finance markets, the situation is a bit more complex. When the pandemic hit, we saw a sharp decrease in global trade, followed by a rapid contraction of economic output. The finance gap has grown significantly this last year, and subsequently, there is a significant unmet need in trade finance globally, which is more dire in emerging markets. The market is faced with not only a large funding gap, but there's also a supply side constraint, with some of the larger players, namely the large number of commercial banks, starting to refine and constrain their appetite. So for investors who are looking for yields due to lower returns seen in traditional asset classes, fixed income and corporate bonds, it's not surprising that the global trade finance sector looks enticing. It is a significant size market with a trade finance gap, with short-term trade flowing and short-term financing opportunities, often self-liquidating with a great track record. And according to ICC statistics, the default risks for trade finance overall is low and stable, and there are high recoveries. So entering into trade finance requires, in essence, the right partners. If it's done with the right partners, it can be a great diversifier as part of a traditional credit allocation.
Thanks, Zoe. Dale, same question to you, please. In addition to, I guess, the right partners, what else do institutional investors need in order to kind of get involved and help with this this gap that Zoe has explained and laid out for us?
Well, for us, we really started taking a hard look at this in COVID. Obviously, very hard on all companies, or many companies. Some tech companies did even better, but for us, focusing on, as Dawi said, emerging markets, and especially small and medium enterprises, you had to understand that it was all that anybody could do to just keep the lights on, right? So most did not have access to something like we had in the U.S. with the Paycheck Protection Program. Even then, businesses struggled to stay afloat. And so, at the same time, when you're trying to keep your employees, employed, when you're trying to keep supplies moving through gummed up logistical chains, trade terms were getting worse, right? So, for us, again, raw materials need to be procured generally in cash up front. The big buyers with high credit are paying, 30, 60 days later. So liquidity was essentially just gone for quite a long time. And so now, in the post-COVID world, what happens when, as we're talking about, with all the liquidity entering the market, all the stimulus programs, what happens when that pent-up demand is unleashed and you have all these businesses that have spent every, penny of their reserves and working capital, just staying afloat. And so I think the real opportunity for trade finance now is to provide capital for these businesses to come back. And of course, we'll talk about ESG and impact investing in a bit. But there's also this opportunity to make sure that there's that build back better model if you're supplying capital, so that as the orders are coming in, as in our field, especially as raw materials and extractive industries might have an impetus to do even more damage as they rush to build supplies, to do that well and to make sure that again, these businesses are able to come back, they're able to hire back, but doing so in a responsible way.
Yeah. Thanks, Dale. And sticking with you, let's move on to that topic of ESG. So what is the role that ESG can play in this new investment landscape, and what opportunities does it bring?
Well, so I think, first of all, understand that ESG, as I think everybody knows, there's been a lot of questions already in the chat. ESG, whatever label you want to call it, ESG, sustainable investing, let's just use those all as synonyms. They're not really, but for now, just assume that there's some sort of lens on doing something differently to address an ESG issue. That's tens of trillions of dollars now in that space. It's growing very rapidly, and the idea, really originally behind ESG standards, which, came way before, this whole impact investing thing over the last 5 or so years, was to reduce risks, right? The idea was to help identify risks especially in emerging markets companies and deal with them in your finance terms. And so, again, with trade finance, you have an opportunity to not only change the kind of the shape of a transaction, but also meet a need of an investor, whether that's a CSR program at a bank and some of their values that they're trying to new values or targets that they're trying to meet, or is there sovereign wealth funds and their sustainable development goal targets and so on. So the idea isn't that you're sacrificing any kind of return to incorporate these standards, but rather, actually creating some kind of opportunity, whether it's risk reduction or even value creation. One of the things that's interesting about trade finance is that it gives you this opportunity to think beyond who your client is, right? So the kind of the neat thing about trade finance is that you're not only your borrower is maybe you examine with an ESG lens, but you are, thinking about up and downstream. And so, a company like a Google or a Microsoft now, if they want to be a really sort of a carbon neutral company, needs to not only think about their lead building in Palo Alto, but also, how their suppliers are behaving in terms of, say, carbon emissions. So in trade finance, you have this opportunity to connect the dots also kind of up and down the supply chain and start to think about what it means for not only your borrower, but their suppliers and their buyers. And that's where I think, the big opportunity is for investment as well.
Brilliant. Thanks, Dale. Dawi, same question to you. Opportunities, but then also maybe you can touch on the challenges and the downsides of incorporating ESG into trade finance.
No worries, Shannon. As Dale mentioned, there is a lot of upside. And the real story of the importance of sustainability in the wider market is that the asset class lends itself nicely to fulfilling the aspirations of the SDG, Sustainable Development Goals outlined by the United Nations. Trade finance directly, as we all know, deals with the real world economy, and it has the ability to drive economic development through facilitating the movement of goods and services. According to McKinsey, the typical consumer company's supply chain creates far greater social and environmental costs than its own operations, accounting for more than 80% of greenhouse gas emissions and more than 90% of the impact on air, land, water, biodiversity, and geological resources. Thus, trade finance is a critical piece of the sustainability puzzle that cannot be ignored. And it's important to mention that beyond the positive impact on society, embedding ESG in trade finance, as Dale mentioned, addresses the asset owner's risk problem because it ensures top-line risk mitigation and it improves companies' capabilities and reduces risks. So the challenges in the application, in theory, ESG sounds relatively straightforward. Everyone's like, it's a great risk mitigator or it's great impact on society and the environment. However, when we look at it practically, it is extremely difficult due to a number of factors. And I'll focus on three for time's sake. First, it's the issue of standardization. Currently, there's no mutually agreed upon definition and standards, which causes issues for benchmarking and analyzing data, but also on knowing what we're talking about. As Dale mentioned, the terms sustainability and ESG are being used interchangeably. But when you open the hood and look inside them, they mean very different things. The second biggest challenge and probably the biggest obstacle is the lack of useful data and the fragmented information, both on the client side, but also verifying that data independently. And applying an ESG risk lens requires material information on those firms. Unlike the equity space, where clients are public and data is plenty, in our space, many of our clients are privately held, and there's not much publicly available data for them. Also, geographically speaking, we service clients in emerging markets in both Asia and Africa. So for us, ensuring we have global coverage on that data is very important. At Channel, we've had to create 4 layers of defense for our ESG data, leveraging multiple external partners and data providers, but also leveraging some existing internal data that is already prevalent and existed on our clients to truly capture material information that's important. And lastly, the challenge of driving and measuring impact-focused investments, right? Going from the downside risk to the upside opportunity of ESG within our asset class, and how to effectively show a correlation between our investments and a positive SDG output. These is what we would say are the main 3 challenges for us, and we're looking forward to working with our partners and our clients to come up with some innovative solutions for them.
Thanks, Dowie. Dale, coming to you on the same question, are these, it was a very comprehensive overview from Dowie, but any other challenges that you guys are kind of coming across when it comes to, thinking about or incorporating ESG, any of the sort of downsides that you care to mention?
Yeah, there are a few, and as Dowie said, some of these are not unique to trade finance, or just unique to thinking about ESG investing in general. And then this idea of standardization is key. So just to add on to that a little bit, there's a great paper by some MIT faculty. They labeled this ESG confusion, and they did a study and they analyzed kind of the key providers of ESG metrics, and they saw that these metrics prioritize different factors, and as they would. And of course, as Dowie mentioned, that makes it hard to understand as a investor what you're actually looking at, but also think about the capital, the companies that are taking on that capital, and if they're using that as a guide to how to behave in order to attract capital, maybe lower their cost of capital, there's also confusion there too. So that's an issue, again, not unique to trade finance. And the other piece is, of course, that as you add on any kind of layer on your investment mandate, you're necessarily narrowing your market. That's, again, not unique to trade finance, but you have to, if you're serious about this, you have to exclude businesses and products from your business, from your fund, from your origination strategy, and that's hard for some groups to stomach, but it's required, right? And it's the price of adopting these kinds of screens. But at the same time, we think that it also is going to expand opportunities, expand potentially competitiveness, reduce risks, improve your possible returns, and so on. But I think the big issue that is unique, the big challenge that is unique to trade finance is this issue that I referred to earlier, which is kind of you have this opportunity to look up and down supply chains, but it's also really hard. How do you influence a business that is not your borrower, you're not contracted with necessarily, as directly, that's not your partner? So, how do you, if you're a factor, how are you influencing some blue chip, company, who's just paying an invoice? You have very little influence there. And then on the supplier side, I think you have a lot more opportunity, and that's where we're focused. But it's just not, it's not fully figured out, and it's not an easy thing to do. There seems to be quite a lot of thinking about how to use terms as carrots and sticks, as somebody mentioned in the earlier panel, I think, to kind of drive behavior. And I think that's, again, a great opportunity for trade finance in general.
Yeah, Thanks, Dale. And I guess, excuse me, just having a look through all of these very many chats that have been coming through, I guess the point that we're trying to make is just because it has these challenges, just because it might be difficult to do doesn't mean that you're not going to be incorporating these criteria. It remains a fundamental part of the business. Great. So we have just a few more minutes left in our session. So Martin, bringing you back into the conversation, please. This is maybe a sort of fundamental question, perhaps, but I mean, personally speaking, I've been working in the trade finance industry for just over 13 years now. It feels like we've been talking about trade finance as an asset class for quite some time, but how come we're still sort of having the same conversation? What can be done to increase investment levels, whether that's bringing in more investors or maybe bringing in a greater share of the existing investor purse? I'll start with you, Martin, then I'll come to you, Dale.
Yeah, very, very good question, and to be honest, different answers. I'll give it a try with one. I think, as I mentioned earlier, it is an asset class with some structural barriers to entry. Most of them are operational, but there's others as well. So you have to, if you want to set up your fund correctly, you have to spend a considerable amount of energy and time upfront before you can even start printing the first ticket. But then once you've overcome it, it's actually quite a nice place because there's a lot of variety of product, a lot of variety of risk profiles, which match very nicely through the cycle. Yeah. But it is not easy. It's not like buying ABS or buying bonds in the public markets. It requires a lot of right setup, and if your setup isn't right, then you will face shipwreck. And we've seen that in some cases. And again, it's not that is wrong about the asset class, but if you set it up too simple or too simplistic, and you don't follow basic rules of concentration, basic rules of counterparty management, basic rules of due diligence and in-depth knowledge of your assets that you're buying, basic rules of operational control, things like this. If you don't follow that, then it's not the right asset class for your approach. Now, investors will come. I think the interest rates are still very low. People are looking for alternatives. The financial repression that we've seen in public markets for a decade now is still very much in place. So I think investors are opening up and are spending the due diligence time, which is good. And I think trade finance, with more funds out there, more approaches to the asset class, I think it's going to come. Yeah. You mentioned what can be better. I think one area which is is slightly different from a fund manager perspective to a banker buying transactions. Oftentimes the confidentiality agreements with the corporates are very, very tight. And our investors would wish that we could share more information with them, ongoing, but also upfront. But the NDAs that we have to sign on the other side oftentimes don't allow that. So that is a bit. A bank wouldn't have that problem. We do have that problem, and that is ultimately comes down to trust. Do investors trust us enough that we do the due diligence properly and don't share all the details with them?
Great, thanks, Martin. Dale, final word from you. We're just about out of time, but maybe just very briefly, what can we do to change the conversation?
Well, I can only address that from my world of ESG and impact investing, and I think that there's a huge opportunity there. If you're serious about it, again, not just as a marketing ploy, but as a meaningful strategy, it's got this double benefit of potentially reducing risks and increasing performance. And we know that as that there's money looking for strategies that incorporate those ideas growing every day, and there are investment managers who are looking for such vehicles on behalf of their clients, right? That is where the opportunity is, if you're looking to increase investment levels. And again, it has this opportunity to maybe deal with some of the risks that maybe our investors are getting a little skittish over some of the recent issues in the news and so on. And I would just say that the last piece to be wary of in doing so is sort of this balance between complexity and kind of where the money is. I saw some of the chats where like, oh, it's how do you really implement this? It's complex, it's costly to measure, and there is this interesting kind of dichotomy between investors looking for innovation and neat new things and the idea that really all the money goes into simple things. And so trying to find that right sweet spot, I think, is key if we're going to drive a lot of money into sustainable trade finance.
Yeah, well said. Dale and Martin and Dawi, you've all been brilliant. Thank you so much for sharing your views with us today. On that note, I'll hand back over to Jeff. Thank you.
Thanks to Shannon and her group for their perspectives. A lot of questions, as mentioned, coming in, and we'll do our best to get into those at the end with our final group. But our next discussion looks at how, with more banks looking to transfer balance sheet risk and much interest from investors, technology has an increasing role to play in creating an active distribution market. And to take us through this, we have Christoph Gugelmann, who is the founder and CEO of TradeTech, a platform that provides investors and originators with the technology to manage trade finance investment. So Christoph, over to you. Thank
you so much, Jeff, for the introduction. So trade finance is an operationally intense asset class, as we just heard. And obviously secondary market trading thereof is particularly sensitive to transaction costs, is not really yet used to real-time processing. And this panel, as you just mentioned, is looking in depth at the automation and technology part. We have an amazing group of panelists. We have a lot to cover. We have very limited time. So without further ado, let's dive into it right away. May I ask each of the panelists to do a quick introduction, maybe starting with Marilyn, then Bertrand, then Mead.
I'm Marilyn Butner-Hoyle. I'm the Global Head of Trade Finance at AIG, and I'll provide the insurance perspective of how we've actually provided trade credit insurance to fund structures for over a decade, and certainly technology has been an absolutely critical part for transparency in getting those deals done in the right way and in a way that investors really understand and can monitor what they are covering. So I look forward to discussing all of that with the group.
Perfect.
Yeah, wonderful. Well, my name is Bertrand Lecominges. You can pronounce this in English, French. I'm actually Spanish, but I won't bother you with that. Currently working for Santander Asset Management, part of Santander Group, running the trade finance strategy at the global level, launching several funds and as investment officer. Previously, for many years, actually leading the structured trade finance business at HSBC, JP Morgan, and ABN AMRO for some time. So that's my background. I'll stop there.
Hi, thank you, Bertrand. My name is Mead Wells. I'm the founder and portfolio manager for Octagon Asset Management. We're a dedicated trade finance and commodity finance alternative investment fund manager. Started back in 1998 after I left Cargill. We're on our 5th fund, and we manage money for various institutions in separately managed accounts. So,
perfect. Thank you so much. So let's first look at how your respective companies currently originate trade finance, and maybe also explore a little bit, speak about the limitations you might face as a risk underwriter or as an investor. And always obviously having kind of the automation technology in the back of our heads. And then we, in a second part, we'll dive into precisely the technology and the required aspects. So maybe if I could start with Marilyn again, what are the challenges for credit insurers to originate trade finance efficiently currently, if any?
Yeah, so it's a good place to start. And origination, I would say, is not necessarily the biggest challenge because there are lots of deals out there. Banks obviously do large volumes, and then there are other providers that do as well. What I would say is the biggest challenge is transparency and then pricing alignment in terms of the risk profile that you have in the pool or in the structure that you have.
We've been around since 1998. So over the past 22 years, we've originated transactions through a variety of different channels. We do a lot of commodity finance, inventory finance, and pre-export finance. In fact, we finance really any step of the supply chain, from goods in the ground, goods in warehouses, goods in transit, and goods once they've been delivered, giving rise to a receivable. As a result, we've got contact with really every step of the supply chain and every party that's a provider to the trade. So we work often with collateral managers, warehouse managers. They're a tremendous source of origination. We get insurance companies coming to us. We get banks coming to us referring clients that they can't fund. We don't really compete with banks because we look at the sector of the market, which really doesn't qualify for bank financing. So we actually are, we view ourselves as a very much an incubator for the companies so that they can develop the skills and the experience as a institutional borrower. We actually train them on how to manage covenant reporting and all the other matters necessary to be a really qualified institutional borrower. And so we have a very strong relationship with banks around the world, in emerging markets specifically. And but we get referrals from brokers and investment banks, other companies that we've worked with as we finance, let's say, an exporter. They have multiple buyers in various destinations. We have to correspond with those buyers to verify the purchase contracts, to verify that the goods have been accepted, to ensure that the payments are being made to our collection account or to our account. So having that dialogue with these buyers leads to new opportunities as they need to finance their purchases and sales as well. So there's a wide variety of channels to originate transactions.
I was saying similar, that actually there are a wide variety of channels for origination, and certainly insurers can be a fantastic partner in that space. The key, though, that we find is how do we quickly understand and have the transparency on the entire asset pool to be able to then correctly price and structure the deal. And so that's why technology has been so critical to insurers being able to provide certain clear cover in relation to these fund structures. And where you lose that transparency, things go wrong. But we'll talk more about how technology can help in the next section.
Perfect. And Bertrand, trade finance is less accessible to capital markets. If I log in into Bloomberg, there's not much I can find. So why is trade finance so different?
Why is so different? Well, there are many reasons. And actually, our panelists in the previous two panels mentioned a few. Dave, Martin, Ulla, and others mentioned about that. At the end of the day, trade finance is a jurisdictional, well, there are multiple types of trade finance. You have the traditional trade, letters of credit, documentary, guarantees type of business that is still very significant. Then you have the structured lending, and many of the speakers have been talking about actual structured trade finance or structured commodity finance. And then you have what you may refer as open account or receivables. And these are three very different businesses. And then on top of that, you add the jurisdictional layer. Capital markets are very, very liquid in a specific jurisdictions around the world. There is actually a negative correlation between the access to trade finance or sophistication of trade finance and the development of capital markets. But traditionally, trade finance, because need to adjust to the jurisdictional environment and the operational environment, actually can become quite sophisticated. And translating that into capital market investors can take time. And not everybody sometimes has positioned this in the right way. It is oversimplified in some occasions or overcomplicated in others. So that's probably the major challenge. It's about education. And I hope my answer manage your expectations on the question, Christoph.
No, perfect. Thank you. So let's look at how technology can help, with asset sourcing, origination, transparency, which Marilyn mentioned before. So maybe, again, Bertrand, so how important is the reduction of transaction costs through automation? Is this a game changer? Is it a nice to have?
it is not a nice to have. It's a must-have at the end of the day. There are enormous volumes of data that are required in trade finance, and you need reliable partners. I believe we are probably now in the third wave of fintech investment over the past probably 25 years in the trade finance world. And we can see still operating fintech companies that were created 25, 30 years ago. But technology is fundamental because we need to create an agile environment to reduce barriers to entry, to reduce what Martin Opferman mentioned before is the natural operational challenges of trade finance. That will be the first point. Then we need to facilitate the exchange of data between the originators, being bank, being funds, being developing economies, financial institutions or insurance companies, anyone else, then the asset managers that are a very different animal, and then the final investors, pension funds, insurance companies, and others. And actually, technology may facilitate that transparency on data into the final investors from the originator. And last but not least, is still a very important element. We can use big data, artificial intelligence, and blockchain and others to reduce risk, to make the investors much more comfortable and increase security on the data flows. So these three pillars, I believe, can be fundamental, and technology can bring those into the fore.
Meet, what workflow processes benefit from automation in your business, and what are you currently automating?
It's a good question. This business is a very paper-intensive business, and as a result, it's very human resource intensive. So you've got to have strict policies and procedures, roadmaps for everybody in your organization to follow to ensure that you don't miss a step, you don't miss crossing a T or dotting an I. We've developed technologies internally to help address those processes, and it's really a game changer. I think obviously trade tech is out there, and there are many other fintech platforms designed to solve for some of the friction in the world of trade finance. We have a long way to go, but we've come a long way. And the real benefit, in my opinion, is risk reduction. It's not so much the workflow reduction, but it really is the risk reduction, because if you make a mistake in the process, it can have detrimental impact or a huge impact on you. And often with a lot of deals in the pipeline, a lot of people working on the deals, and a lot of information flowing back and forth between the various parties in the transaction, it's very common to have something miss, or someone miss an email or some kind of component in a transaction. And that's where you can get hurt. A lot of the trade finance funds that have not made it have failed because of bad processes and decisions that ultimately came back to haunt them. But fintech is going to be a critical piece of the equation, because it not only does it automate the processes, but it standardizes things, and it allows for auditing and oversight, which is critical to risk management. And that's the most important thing in any institutional asset class. If you can manage the risk, then you can identify the return and understand the relationship between risk and return. And right now in trade finance, there's a disconnect between what is the real risk you're taking and the return you're getting for that risk. And that leads to opportunity, but that also leads to problems.
Marilyn, you must, AIG must be using lots of systems, third-party systems, internal systems. How do you make sure, kind of like that everything is interoperable? How do you make the decisions, what to make, what to buy on the technology side? Maybe just some thoughts.
Yeah, absolutely. So on the insurance side, we clearly have to understand all of the assets in a pool. And so we partner with different external providers. For example, there's one called Aranova that we've been working with for over a decade, as I mentioned before. and we will set up the system so that we can test the eligibility criteria of the policy to, one, ensure we understand what we're covering, but two, to give certainty to the funds or to the banks that are supporting the transaction. And that data isn't just a kind of ongoing monitoring thing. It's also used at the due diligence stage to ensure that everybody understands what's being covered and what's in the pool. And then, of course, on an ongoing basis, because trade finance assets aren't homogeneous, they change all the time, and that data is critical. Additionally, in order to drive that certainty for our clients, we have to have our credit limits, so the obligor credit limits, being pulled from our systems, and they are directly connected, again, to the systems like Aranova. And so that, I would say, is one very critical part of technology. And it allows for reporting as well. And you know, Christoph, maybe you'll mention about what trade tech does, but what we find is often, because funds aren't necessarily trade finance specialists, they want simplicity of data, but they want to know that their partners understand the granular picture below. And that's where an insurer can really add value. The other place where I would say technology has been critical to us, and it's driven some very positive outcomes, is anomaly testing and connected party testing. And so when you get all of this data and you can start to use algorithms and find connectivity, et cetera, you start to be able to draw out issues. And there are cases where we have seen, for example, due dates being changed on running programs, due dates being changed after purchase by the funders. Big red flag. Maybe an invoice that's out of line with historic patterns. Connected parties where, you know, DUNS matching or sanctions testing throws up some sort of connection. These are all things that, you know, are impossible for a party to assess without technology being very, very much at the center of the entire transaction. And the only other thing I would mention is bad data in is bad data out. And so at AIG, we obviously try to stand by, and we do stand by everything that goes through our system, but it's also about that partnership and transparency with the seller or the originator, the factor, whoever it might be.
Thank you. I think we have a few more minutes to cover and look a little bit into the future. And we have, you know, kind of all these new technologies emerging, and not just kind of conceptually being there, but really starting to get used, whether this is in the logistics space, IoT, whether this is, you know, distributed ledger, which is really kind of like making big strides in banks in particular. We have cloud computing, we have AI technology. So kind of like, if we project a little bit into the future, you know, let's assume in a perfect environment, all these technologies start to interoperate and become effective. Now, what does that mean for trade finance? You know, kind of meet. Will there be more capacity for corporates in the end, or is it, you know, kind of like just a system which benefits the underwriters and but not really changes the flow of liquidity?
I think the biggest advantages of having technology platforms in trade finance are number one, risk reduction. Number two, scalability. This asset class has suffered because it's not an asset class that has a readily available marketplace to buy deals. So if you raise $200 million or $500 million, it's going to take you a long time to put that to work unless you have a pipeline of deals that you've already incubated and vetted out and done all the documentation on. So that's kept the asset class small because you just can't grow quickly in it without taking on enormous risks. So having technology platforms allows for scale, and that's going to be a game changer for the industry as an allocatable asset class. You know, I've been doing this for 22 years under Octagon, and we have spent enormous amounts of time educating institutional investors on what trade finance is. It's the oldest capital market, but yet it's the most, you know, it's the least well known by the traditional capital markets. It's historically been the domain of commercial banks, and therefore there's, for all intents and purposes, this opaque or Chinese wall between the two. As the banks have retreated from the space, it's opened up the door for non-bank financial institutions to fill that void. So today is probably one of the most amazing opportunities to capture market share as an asset manager in an area that has low correlation, low volatility, high absolute yields, and short duration. These are incredibly desirable characteristics for institutional investors. And if you can get transparency, that really is the clincher. With fintech platforms, you get that transparency, you get the standardization, you get the security, you get the risk reduction. All of these benefits are inherent in fintech. And so it's just a matter of time before this really takes off. I think we're going to see an inflection point over the next 12 to 24 months. So I think it's an exciting time for asset managers in the space. And I would imagine we'll see a lot of new participants join in. And we welcome that, because the more of us out there the more we can educate the institutions, and it'll get them up the curve faster.
I do agree with you, Meet. And Christophe, your company, Tradetech, I think is doing an amazing job on that at industry level. But this effort needs to be done with a much more robust legal framework. For example, there is the BAFTA standard, but that really operates well for unfunded assets. It doesn't really work that well for funded assets, for receivables, and other type of structures, for example. So there has to be some type of homogenization, let's say, on the legal framework, and that will facilitate, together with technology, the share of assets and the attraction of investors as well. And then I think it was mentioned by Ulla in the first panels. He mentioned a couple of times we are an asset manager. And asset managers speak to investors, capital market investors. And I'm not sure the asset originators, especially the big balance sheet ones, the big banks, actually understand when they are dealing with asset managers and other type of investors who they are dealing with. Because these entities are not going to do full KYCs, are not going to do the whole screening of all the obligors and other elements. So there need to be some facilitation of information. And this is where technology becomes vital, to do that in a secure environment and share that openly in order to build that market. And as soon as you build that market, trade finance can keep growing, as it has been doing for many years. And it will keep growing, but it will increase at the speed.
Thank you. Maybe last as a statement, closing statement from Marilyn, kind of looking into the crystal ball from an insurance carrier perspective. Technology, will you have much better risk diversification, better access to risk, or what would you expect will happen?
Yeah, I mean, I would say that as there's this shift towards technology and more transparency, I would hope that there is increased capacity from the insurance market and from the capital markets in terms of interest in this asset class and trust in this asset class. And I think that, when we get there, the other thing we have to all think about is interoperability and making it easy for a wide variety of participants to gain access. And I know there's been a lot of discussion about, whether you can easily transfer trade finance assets, but the more we can actually create that standardization and that homogeneous data framework, the more, wide party groups will be able to access the asset class and trust that they understand what they're accessing, which is so critical.
Thank you so much to the panelists. And I think we are 1 minute over, so back to Jeff.
Great work. Thanks, guys. Many thanks to Christophe and his group for their insights. It'll be fascinating to see how technology innovation continues to push the dial on this issue. And this does bring us to the final section of today's webinar, which is our closing summary Q&A, which I'm delighted to welcome Ian Henderson, who is Chief Investment Officer at Artis Finance, Federica Sambiase, who is Partner and Chief Executive Officer at Working Capital Associates, and Jason Barras, who is Chief Commercial Officer at ARC Rating. So we have a C-level panel. We've had various questions coming in over the Q&A. We'll try and get around to answering as many of these as possible, but it's been very, very busy. So apologies if we can't come to you. We will do our best. First question concerns one of the perennial issues we've heard mentioned before of scalability and the challenges being faced by trade finance funds in achieving scale compared to other forms of investment. So I'd like to start with Jason on this before moving on to Ian. What's your take on this, Jason?
Thank you, Jeff. So I think we're touching on several issues which have already been commented on by several panelists. But what I'll start with maybe is just a newspaper headline that I read recently in relation to the industry here that we're looking at, that we all know and love. And the headline basically said, uncertain future for supply chain finance funds. And this really, I think, talks to the first point I want to make around one of the barriers to really expanding this out. And at the moment, it's a little bit about the perception. And the perception of this touches upon several of the areas that we've been speaking around. We've spoken about transparency, okay? Key area to this, knowing what you're investing in, knowing who you're dealing with, knowing that there's controls in place. I think Ola earlier spoke around knowing about the KYC, okay? If you're an investor, you want to make sure that's done. And unfortunately, what we've happened, and we'll talk about this in a moment, we've had a bad apple in the barrel as it was, and that has really changed the perception in hopefully in the short term around this asset class. And I think Jeff, as we know, this asset class is an awesome asset class. It's got very low default rates, great returns, short-term liquidating. So in itself, there is nothing wrong. And I think Martin, earlier mentioned that point as well. A perfect asset, but it's around part of the structuring. It's around part of the ecosystem, the partners in there, which hasn't, in my mind, really totally matured enough yet in order to allow it to move to the next level. And I suppose I'll just make two more points for handing on to Ian. One of the structural points around how we can improve this in order to move it into a truly accepted investment is around some of the structural deficiencies. Ian will perhaps touch on a few more, but I mean, just one which is common at the moment. It's around the cover termination of the insurance. And as we look to get new investors to come into this asset class, we're going to have to go back to the industry, to the wider market, and address some of the concerns which have unfortunately been highlighted recently. And I suppose the very last point around this is, if we really wanted to grow the market even more, specifically now in an asset class which is relatively immature in its growth, it would be to add on an additional layer of comfort for investors. I've been speaking to some clients already, and there's a big difference between an asset coming out without a credit rating agency approval on top of that, and one that does. Basically means there's an additional overview onto that, and it brings in additional investors, lowers the overall pricing, makes a much wider participants in the market. And that's, I think, another angle that we need to look at. Ian.
Thanks, Jason. Afternoon, everybody. Some very good comments from all the prior panelists and the sessions. I think Mead touched on this topic of scalability. Trade transactions do take time to originate and perfect for funding. So it's always a challenge for fund managers to balance the funding commitments versus the available capital. You have deals maturing, you need to replace assets. So inherently you have a cash drag. What we have seen when funds do start attracting larger flows of capital, they're trying to run this balancing act. They often take the eye off the credit and risk management processes as a result to ensure they are deploying funds. And that's where we've seen problems. But when you look at the institutional investor side, they're used to investing in different asset classes where they allocate larger sums of money. And this is a bit of a chicken and egg situation for funds. You need a track record and you need an existing scalable AUM in order to attract further large inflows. So it often becomes a chicken and egg situation to get to those scalable levels. And I think as a result, we're seeing a number of newer vehicles in the market, which are looking at debt capital market solutions, focusing on more homogeneous, standardized type products with more transparency. Coming back to all the other topics that have been raised already, where you do note programs, you have a rating, you only do receivables with credit insurance, and every trade looks the same, despite the diversification in the underlying flows. So I think scalability is being addressed, but it has been a challenge for all the funds that have been out there in days gone by. And I guess that's where you have some of the more institutional funds, but like the Allianz offering, the Federated offering, which are more around risk participations and partnering with banks in larger trades. And once again, getting comfort from an institutional framework around the individual trades. Obviously, yields are a little bit lower compared to the high yield environment, which are in the other more alternative niche or strategy specific funds.
Great. One of the other points raised has been around liquidity mismatches in terms of funds potentially being more liquid than their assets. So this one for Federica, to what extent is this a concern and what measures can be taken to avoid this?
So thank you very much, Jeff. So liquidity mismatch is not at all an issue just related to trade finance. It's an issue that is not new, and it is across asset classes from equity to debt and across types of financial institutions from banks to funds. And several steps have been taken over the years from a regulatory perspective to avoid the suspension risk for investors. But however, these regulatory steps do absolutely nothing to address the fundamental flaw of having illiquid assets in vehicles that have actually short tenor liquidity. And this is true across asset classes. We can remember the 2 years ago in 2019, the case of the Woodford Fund, a £4 billion fund that was suspended on the back of illiquid investments in short cap. More recently in 2020, the case of a Singaporean oil trader that had a ripple effect on the commodity finance market and on the trade finance market. So liquidity management is really the holy grail for any fund manager across assets. What can be done? I mean, you asked it is a concern. Yes, it is a concern because especially in period of stress, this is puts an enormous stress on the industry. Let's think about a clear period of stress, the first 6 months of 2020, and Fitch has estimated that 62 billion worth of funds were suspended. So redemptions were suspended. This is double the amount of yearly redemptions. Why? Because of course there was a perception, there was a stress across the market, and investors rightly exercised their right of redemptions. So what can be done? There are three classic strategies that are implemented by fund managers. First of all, portfolio differentiation. So we are speaking here about trade finance. So there are several products that can be utilized in a trade finance specific portfolio, ranging from shorter tenor sort of post-shipment products, so receivables finance, supply chain, reverse factoring, to longer dated products such as procurement finance, stock finance, inventory finance. So diversification in terms of products and their tenor at portfolio level, but also, and perhaps more importantly, at investors level, diversification of investors. Investors with different risk appetite, risk tolerance, but also different profiles in terms of their own liquidity needs. Because one thing that was prevalent across all the recent suspensions and gating is the profiles of the investors. Very similar profiles sometimes, and oftentimes very large investors compared to the rest of the investor base. And so this, of course, caused a run on the bank, suspensions, gating, which is, of course, not good for the market. So diversification of the portfolio, diversification of investors, and last but not least, redemption timing. So to match the redemption timing with the estimated liquidation timing required by the fund manager to liquidate the assets to satisfy the investor request.
Jeff, I can just add, thanks, sure. Federica. I think valid comments. I think obviously for the trade finance fund marketplace, I think there is a move where a number of new funds and existing managers are looking at some closed-end structures to try and address the liquidity mismatch as well, just to protect themselves against investors. Sometimes when you bring in large investors, you try and lock them in for a period. So whilst your fund might not have different share classes that cater for closed-end structures, you can always put longer notice periods on for large investors so they don't destabilize your fund should they pull out the money. So there are different mechanisms you can use as a fund manager. But when you're fundraising and trying to get your fund off the ground, you willing the capital to come in. You often bend over backwards to get the investors in, and down the road, that's where you've got to face the challenges on the liquidity mismatch.
Certainly. I guess the next question moves us on to issues around transparency in determining fair value. So stick with you for this one. There's been a big drive on this, but things have still on occasion gone wrong. So what, in your view, and maybe get Jason's view as well from a ratings perspective afterwards, but what's been the impact of IFRS 9 and IFRS reporting when it comes to auditing and evaluation process?
Yeah, Jeff, I mean, the asset class and from some of the earlier funds, and I think there's still some funds experiencing some of the issues where there's been a bit of extended pretend on some of their non-performing assets in the portfolio. And, this comes down to the transparency for investors where, maybe provisioning and revaluing these assets hasn't taken place at the appropriate time. They haven't been disclosed to the investors early enough. And then suddenly there's a nasty surprise, which, gets an investor's back up pretty quickly and they will put in a redemption request and could lead you into all sorts of trouble. So I'm hoping with IFRS 9 and in turn the auditing firms becoming a lot more stringent and getting a better handle on trade finance assets as such, where they're really looking at the valuations and looking for independent valuers, looking at proper expected credit loss methodologies being implemented by managers, that this will reduce to some extent. We've certainly seen a number of audit firms being pretty tight on existing funds and other fund structures in recent months where they've refused to sign accounts and managers have had to look for alternative auditors as a result. So I think it will have a positive impact. It's a pretty painful process if you haven't run through the modeling on provisioning and ECL models for a trade finance portfolio, particularly as a fund. Obviously, if you sit in a bank, you have a raft of finance teams to do this for you alongside your capital risk weighting models. But in a fund, it's something everyone's had to address and get used to doing. But I think it's a welcome and hopefully will drive this transparency. But it goes beyond just the IFRS 9. I think it's trying to get further disclosure to investors is key and giving them sight of the portfolio rather than these being black box operations.
And I think, from a credit rating agency's perspective here around transparency, the role of the CRA isn't to give credit approval, right? So we're not a credit committee, we're not a bank, or anything along those lines. But our role basically is to take a step back and look holistically across the fund, as it is, and identify the strengths and the weaknesses, but to do that independently, which I think is very important. I think when we look at the failures that we've had over the last few years, it's mainly been around the governance. We talk around fraud, but we talk around some of the basics. Now, I was a banker for 25 years for my sins. And when I used to hate governance. But now coming outside, I can really see the importance, because as we're looking to sell these assets to investors who are not, trade finance experts, we have to make sure that the organizational structure, that the asset that we're promoting is actually going to work out. I mean, Ulla spoke before, she says, it's unknown to a lot of these guys. We have to start to give that confidence. And I think as a credit rating agency, which actually has some experience, understanding around trade finance, not following a kind of like tick box exercise, then you can really start to add some value around that. You can add an independent overlay. You can ask the right questions, and you can start to provide for the ultimate investor a little bit more comfort. So I would say that governance for me is one of the major areas that we need to work on to allow for greater transparency. And that could be as we do new funds, also we, as you clients out there do new funds, you start to look at independent credit reviews as you look along, independent committees to assess the assets as they come through, making sure that there's not one counterparty which is controlling the center and manipulating all the parties there, which is what we've seen in the Greensill debacle. But we'll get onto that in a moment, Jeff, right?
Absolutely. In fact, I think you've had to pick one subject I have the most questions on. Unsurprisingly, it is the rather large elephant in the room, as some have said, or the bad apple, as you referenced earlier, Jason. So the issue of Greensill and its potential impact on investor appetite, I'd be keen to hear all of your takes on this, perhaps starting with you, Federica.
Yes, the big elephant in the room. So I think I would like to use a word and make a comment around a concept that has been expressed by various panelists, and it is perception. So the perception in the non-specialist market, so in the non-trade finance specialist market after the Greensill case, has been around the fact that receivables financing and supply chain financing are the worst culprit in the Greensill debacle. It is a product issue, and the responsibility for the debacle is because of the product. And this is a perception. And this perception is actually inaccurate. And we, as a trade finance community, we have the responsibility to clarify where this perception is inaccurate. Receivables finance and supply chain finance are traditional merchant banking, commercial banking products that have been utilized for decades in a very successful way. They have certain structures and parameters around the existence of a receivable. So there needs to be an obligation of the buyer to pay for some goods to a certain supplier. So there needs to be an underlying asset that creates the receivable. And this underlying asset is normally an invoice. So it's very clear parameters. What we have observed in the Greensill case is that the bulk of the assets were represented by investments in procurement, so procurement finance, stock finance, inventory finance. So financing provided to the client to procure the raw materials. So I read in the press, somebody described them as future receivables. There's no such a thing. There isn't a future receivable. So either it's a receivable or it's not. It's like asking, is the rain wet? It's obvious. There is no receivable. So the perception needs to be really addressed. Receivables finance is a very simple product, very standard and very plain vanilla that has actually nothing to do with the Greensill case.
And I guess, Ian and Jason, anything to add on that?
I suppose from my perspective, as we talk around Greensill, whilst we do talk around a bad apple, I would say that it was probably also a bad case study amongst quite a few of the members in that ecosystem. I think there are lots of lessons to be learnt from the due diligence that we would expect partners in a trade fund to do. How far do you go in checking an insurance policy? How far do you make sure that your credit rating is independent? Some of these basics, I don't think, were followed. So I think going forward, when we talk around perception, Federica, I totally agree with you around that. We again need to make sure that our governance is stronger, our structures are tighter, that we almost have comfort that the Chinese walls that are built for our protection of the investors are actually doing the role that they're supposed to be doing. Ian.
Yeah, I think just a final comment. Greensill's not alone. There was a case a couple of years ago from a company called TFC, which is doing Sharia receivables financing, sold a lot of risk to banks and institutions in the Middle East. And I think a relation became very comfortable. No one questioned the documents, and funding continued. And I think to a certain extent, Greensill became a machine. The distributors of these assets weren't taking a close look at the underlying documents. I don't think there was full disclosure. So it's really a governance and operational risk that's been overlooked as one of the major causes here, rather than the asset class or the product, to be honest.
Great. I think we're nearly out of time, actually. We've had so many questions. I think apart from the Greensill issue and issues of ESG, I think the other question we've had most come up from our audience is the role of insurance when it comes to valuation and how it can have an impact. Federica, coming back to you, what's your perspective on the role that insurance can play?
So credit insurance has clearly an important role to play in the trade finance space. And it is interesting to notice the evolution of credit insurance from a pure business and commercial tool to protect businesses from the risk of non-payment for commercial trades to an increasingly utilized tool for funds to protect the portfolio from the credit risk of the ultimate obligor. So credit insurance is a specific type of insurance, and it protects from, and it's been utilized very successfully in businesses for decades, because it allows suppliers to sell more and more confidently on open account. So giving terms to their buyers without utilizing clunky and often expensive banking tools like letters of credit. So it has been utilized very successfully for decades in the commercial trade, and now it's been utilized very successfully it's been migrated to the financial world. Again, very successfully to protect against the risk that the ultimate obligor in a trade finance transaction fails to fulfill their obligation to pay for reasons that are independent and outside the control of the supplier. And these reasons are linked usually to insolvency, bankruptcy, or political risk in the buyer's country. So this is what credit insurance do. And credit insurance, going back to Jason's point before, it adds a relevant mitigant. It's not a solution against all evil, but it adds an important mitigant to the risk of a trade finance fund from a credit perspective. And it is actually quite successful and quite helpful for those funds, those portfolios that are structured around post-shipment financing. So receivables finance, supply chain finance, where the execution risk has been eliminated. So there's no procurement risk, there's no transformation risk. Everything is around the ultimate obligor risk. And it works policies like that in favor of funds. So the financiers actually work quite well. This is what insurance policies do. What credit insurance doesn't do, and this goes back to Ian's point earlier about governance and processes and procedures. Trade credit insurance is not a solution against all evils. It doesn't, and it cannot, and it shouldn't substitute a proper, a prudent and thoughtful credit management by the fund manager. And this is very important, and it is important also from an investor perspective. Having an insurance policy to protect the portfolio, of course, is an important mitigant. But the role of the fund manager is to ensure that the risks, the KYC, the DD, they are all taken care of in a prudent and thoughtful way.
Final question. Before we're obviously very close to being run out of time here. We've seen a lot of questions coming in with regards to the trade finance gap, the struggling issues for SMEs, and how the world of trade finance funds can address some of the challenges faced globally when it comes to financing trade. So I guess a quick question for each of you, as well as any sort of final statements. Where geographically and in which areas do you expect to see the best growth opportunities for the world of trade finance funds? A lot of people have been saying, the conversation is focused very much thematically, but in terms of regions, sectors, geographies, where do you see opportunities? Perhaps starting with you, Ian, with your role at Artis and where you're looking at present.
Jeff, so I think just on the SMEs, I think SMEs in all countries are striving for funding. So I think there's a gap, whichever country you look at. Yeah, it's not only emerging markets, UK, US, Europe, SMEs are struggling for funding. So it's finding those models. And I think the rise of the fintech platforms where they can handle these lower transactions for SMEs and try and interface them where they can maybe raise wholesale funding themselves to become funding partners. I think there should be a drive there. We've certainly seen this happen in parts of Latin America and in parts of Africa, where you need local currency funding rather than hard currency funding, number one. And then I think just in terms of the whole trade finance gap, we still need the banks. Hopefully the banks do come back. They are still out there. They haven't retreated fully. We still need them in trade finance, regardless of what size institution you are or borrower. And then from an alternative space, hopefully these will continue growing in number, and not only funds, but origination servicing companies, a bit like Artis, where we use the debt capital markets for financing trade transactions and programs. And I think we'll see more evolution. And we've seen different structures and strategies springing up, those that address PPE and now ongoing health and medical supply chains. There's the food supply chain finance specialists. You've got the impact supply chain finance specialists in the market. So there's more and more names and diversification coming in the market, but there's a growth area all around. It's really, I think we mustn't lose sight that it's all trade related. Trade continues. And yes, maybe some of the default rates and LGDs and et cetera in the market a little bit out of date and have been focused around the bank market. So I still think there's a big need to improve data and data flows and statistics and historical statistics for the asset class across the spectrum of SMEs to large investment grade corporates.
So I think from my perspective, I think, the next 12 months will basically see the fallout, unfortunately, of COVID. Kind of expecting to see a rise in bad loans, NPLs, but out of that, we'll start to then see the growth come through. And we all know that trade is basically the heart of the global financial system. Like everything starts with buyers and sellers. Forget about foreign exchange, acquisitions. It starts with the industry that we're involved in, okay, which is why it's such a really important asset class to do. So what are we seeing? We're seeing inquiries coming all around the place, really. We have sister companies all around the world. We're already starting to see the initial inquiries, but it'll take a little time for the effects of COVID to really trickle through. What do I think for the funds area? Banks have limited options, right? The regulation is not going to get easier. If anything, I've seen some articles whereby the RWA requirements, it may even get harder, which will mean that their balance sheets will be restricted, which will mean they'll have to distribute, and if they can become more comfortable structuring deals together, packaging them, working with credit rating agencies, I really do feel we can actually see this asset class move on to its next stage of development. Jeff.
Great. Federica, final quick comment from you.
I will keep it very short and sweet. I agree with Jason. Everything starts with buyers and sellers. And from my perspective, where we focus is food and agriculture, because with the growth of population expected to grow by 2 billion by 2 billion by 2030, more food is required. So trades in food will grow, trade flows will grow, and the need for trade financing for these flows will grow. So that is where we see the need, especially for flows coming from emerging markets, especially Latin America and Africa.
Great, thank you. Well, that brings today's webinar to a close. Many thanks to all of our speakers for their time and to all of you who have submitted your questions. We're really sorry we didn't get around to answering all of them, but there were so many. I think we probably need, as I think someone put on the chat, more than an hour and 40 minutes to address all of the themes around this. I'm sure our speakers will welcome any follow-up. If you wish to get in touch, you can find their profiles on the GTR website, and I think all of them on LinkedIn if you wish to connect, and many of you would already be, I'm sure. We'll make this webinar available on demand via the GTR website over the next few days. You'll get an email of all details, as well as details of who joined this webinar from an attendee side. A couple of quick plugs. We've got various upcoming virtual events taking place from GTR over the coming weeks. We're doing East Africa next week. We're covering the US and UK markets in June, and with the one in the UK, we're even filming live in a studio as we continue our return back to fully in-person events. We'll be going back to in-person from September with proposed locations including Geneva, Dubai, London, Stockholm, Singapore and New York, COVID restrictions notwithstanding, though we are very hopeful with the fantastic progress being made in some areas. Please refer to the GTL website for more details, where you'll also find our unrivaled editorial coverage. Shannon would not want me to not say that, of the trade, commodity, export and supply chain finance community. And there's plenty of material on the issues covered today also. But until then, take care and we'll see you next time.